Okay, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. As we are starting off this week with the S&P and the NASDAQ both continuing to notch new record highs after what has been just a really spectacular rally here off of the April lows. We've seen a pretty a rally that's kind of unprecedented in both speed and magnitude from these April lows. And this rally that we've seen has largely been unchecked with really no consolidation or pullbacks over 3 months of price action, more than 3 months now. And you might notice that the S&P 500 actually generated a counter trend sell signal on the Options Play platform. This is in conjunction with the fact that VIX is now below 15%. So we're in the bottom 10% of implied volatility over the past year, which historically has been an environment that favors being long volatility. We've got a big week coming up. We've got a big week from an economic data perspective. We've got a big week from an earnings perspective. You have a tariff deadline that is still with a couple of big things that are kind of on the table. You have some of the details with the with the deal with the EU that still needs to be hammered out. You have US and China negotiating kind of an extension to the trade deal that expires here in a couple of weeks in Sweden. You still have Mexico and Canada that are still in process of negotiating with the US. So just a lot of market moving catalysts that could potentially move the markets here over the next few weeks, not to mention we've got a higher high in price that's no longer being confirmed by higher highs in momentum. So you have some signs of exhaustion here to the upside. So, by all accounts, whether you're looking at this from a technical perspective, from a fundamental perspective, things look stretched. The S&P is trading at 22 times forward earnings, which is on the high end of valuations. Technically speaking, we're overbought on just almost every single momentum indicator you look at from daily or weekly timeframes. There's a lot of things that are kind of sending some signals that, we could be near at least a temporary top here in equities at the moment. So take that with a grain of salt in terms of what our expectations are going forward. You have an FOMC meeting coming up tomorrow. You have labor, jobs number coming out on Friday. You have GDP this week. You have just a lot of data coming out that we have to digest. And volatility at the moment is at the lowest we've seen over the last year. And the question is whether or not that can continue, or we're going to see potentially a pickup in volatility. Now, we look at kind of the Qs. You basically have almost the exact same. If you look at the Qs, you have almost an exact same chart here, and almost exact same setup. With regards to just a big, strong move here to the upside. And in the last few weeks, just kind of this melt up in the markets here on the Qs, but same level of exhaustion that we see here, higher highs in price, no longer being confirmed by higher highs in momentum, showing us that buyers are starting to get exhausted. We're overbought by just about every single possible metric, including fundamentals. And the question is whether or not earnings can be enough of a boost. Earnings and economic data can be enough of a boost to sustain this rally, or we start to see some at least healthy consolidation and pullback here in the overall markets in order for this to continue. So we're continuing to monitor the markets here from that perspective. You have IWM small caps that has been playing a little bit of catch up here with the rest of the market. As you can see, small caps stalling a little bit here over the last couple of weeks. The cheaper end of the spectrum in the last couple of weeks have not really kept up here. But RSP equal weight S&P 500 index has continued to make higher highs as the market continues to melt up, even though it's not making higher highs at the same pace as the rest of the market. This is something that we're going to continue to monitor to see, how market breadth improves as the S&P continues to make its higher highs. We need to see, we want to see the rest of the market play a bit of catch up here in order to sustain the current market rally that we're in. Looking at bonds, if you look at HYG, high yield corporate bonds, we continue to see kind of high yield confirm kind of a risk on environment, right? So we see bonds continuing to trade higher highs here over the last few weeks. There are some signs of exhaustion here as well as we get higher highs in price that are no longer confirmed by higher highs in momentum. And then lastly, if you look at TLT, look at longer term bonds, this is really kind of the primary corner of the market that is not showing the same type of enthusiasm as the equity markets. As you can see, the bond market has really gone nowhere here in the last, call it 2-3 months here. Yields for both, 10-year and 30 years are closer to 52-week highs than they are to 52-week lows. Now, you can see it two different ways, right? You can see this as the bond market not necessarily believing in the story that inflation is under control, that interest rates have to remain high. You can also look at it, kind of a glass half full type of view that we are potentially about a month away from the first rate cut, right? That is what the bond market is pricing right now, is that we're going to get a rate cut here in September. Consumers have been quite cautious here over the first half of this particular year. If we see interest rates start coming down and we start to see consumers, seeing credit conditions improve and start spending more, that could be the fuel that kind of fuels the recovery in the second half. In terms of economic conditions, I would say that the equity market has kind of already priced some of that in based on the rally that we've seen here over the last 3 to 4 months. But that's really kind of how the bond market is currently still showing us that that interest rates for the moment are staying relatively high and stuck in these particular levels. That is, in the short run, putting a bit of a cap here on how much further equities can move. But if we do see a shift in that, in terms of expectations for rate cuts here for the second half of this year and going into next year, that's really where we could potentially see the economic data play a little bit of catch up to where the equity markets have priced in over the last couple of months. So with that, let's take a look at some of the ideas that we're looking at here for the week. The first one I want to take a look at here is Merck's, the pharmaceutical company. Merck's over the last year or so has really kind of underperformed the S&P 500. This was a $130 stock here back in June of last year. The stock basically nearly halved in value here to around $70. And over the last couple of months, we really started to see, Merck's kind of sort of not quite complete, but just about to complete this bottoming formation here. So you can draw your lines this way. You can sort of say this is still a bottoming formation that's still in the process of being completed. But this is kind of what I'm currently seeing here. And we've seen a lot of these types of setups where the stock has kind of declined for call it a year or so. It spent a few months bottoming, trading sideways, and we're looking for that potential push higher here. You see the trend quality has improved here since June. It looks substantially better here, and it looks like it's potentially on the verge of that breakout here above 85. So this is on the more speculative side of the trade because we haven't seen the breakout yet. We're looking for a potential anticipation of that. But when you look at the fundamentals, that's really where I you have the potential of this. And Merck reports earnings this morning. So we'll see if that is potential catalyst that drives this stock higher here. You know, Merck is only trading at 9.5 times forward earnings, which if you look at kind of the growth expectations, if you look at, 12-month EPS and revenue growth, it far exceeds its industry. And more importantly, net margins on Merck's is 27%, which is double the industry average. So for those reasons, I believe that we're likely going to see a potential breakout here for Merck's based on their earnings report this particular morning. It looks like, unfortunately, the stock's down about 4% this morning, and I'm guessing that's because the earnings report came out this morning. So we'll continue to monitor this particular opportunity based on how earnings came out. I haven't had a chance to take a look at that just yet. The next one I want to take a look at here is Pinterest. We talked about this last week. Pinterest, similar type price action to Merck's from the perspective of, it's kind of completed this bottoming formation around $35 or so, and has kind of broken out above that level, came back to retest this level of support and started to move higher here. Our upside target here for Pinterest is $50. It's currently trading at $38.50. Pinterest trades at 21 times forward earnings, which is basically in line with the industry. But when you look at kind of growth expectations, that's really where Pinterest excels. It is expected to grow EPS by nearly double what the industry average is. It's expected to grow revenue by about 14%, which is a really healthy growth metric for top line. Net margins is really kind of where Pinterest is still working on becoming a more profitable company and continuously being able to turn profitable quarters every single quarter. This is something that historically Pinterest has struggled with, as a relatively newer kind of social media company competing with much larger social media companies. They recently had some tax credits that really helped them with regards to profitability, but that's a one-time tax credit. Otherwise, net income largely on, call it 800 something million dollars in revenue is basically zero. And that's something that we need to see them improve on. And if they can do that, that's really where I think there's some substantial upside here for Pinterest. The next one I want to take a look at here is Block. We've been talking about this here for a few weeks now. Block is formerly Square, which was the symbol for that was SQ. They rebranded here to XYZ. And if you look at this chart setup, very similar to that Merck's chart setup, right? So you have a stock that's underperformed, completed a bottoming formation, broke out, came back to retest that breakout level as support, and now continued to move higher here. Our upside target here is $85, so we're getting very close to our upside target. If we can reach 85, our real upside target is actually even higher because Block only trades at 17 times forward earnings, which is a very substantial discount to the industry average around 27 times. And EPS and revenue growth look very similar to Pinterest. We're looking at about 24% EPS growth, 12% revenue growth, so which is a really healthy growth metric relative to the sector. Block's net margins are also around 11%, which is quite a bit higher than the 8% that the industry average is. So it's more profitable, it's growing faster, and it trades at a very discounted valuation. And that's really where the upside potential here comes from for Block or XYZ. Next one we want to take a look at here is Alphabet. We've been talking about Alphabet here for quite a few weeks here. We basically introduced it when it pulled back here to this trend line. This was the trend line that it was kind of trading up against. And when it pulled back here, that's when we initiated a bullish position here for Alphabet. The stock has rallied substantially since then, and obviously had a nice earnings report last week and held that 190 level here. So now that it's holding that 190 level, then we're looking for it to rally up to that gap fill the gap here, which is around 202 That's the gap that it had back in February on earnings. We're looking for that to get filled here to the upside. Alphabet still trades at a discount to the industry despite the rally that we've seen here this year. Top and bottom line growth is basically just in line with the industry at around 13% EPS growth, 11% revenue growth. But where Alphabet stands out is its net margins, 31% net margin versus 6% for the industry. So if you consider the fact that Alphabet basically trades in line with the rest of the industry from a valuation perspective, it's expected to grow just as fast as the rest of the industry, but is far more profitable. That's really where the upside potential comes in for Alphabet. And arguably that profitability metric is more important than anything else. When you factor into the the potential for Alphabet from an AI perspective, that's really where I think, if you're interested in investing in any of these major tech companies from an AI themed perspective, I think Alphabet is probably the most interesting investment at the moment, just because if you look at Meta, Microsoft, Nvidia, Oracle, any of these major players within the AI space, they're all trading north of 30 times forward earnings, which reflects the growth potential of these stocks, and what these companies could potentially do with AI. But Alphabet is the only one that is arguably doing just as much, if not potentially even more, yet it trades at only 20 times forward earnings. So I think that for those of you interested in AI as a theme, Alphabet is one that you absolutely need to be considering in your portfolio alongside of some of the other names that I just said because of the valuation that it trades at. Next one I want to take a look at here is Target. As we see kind of consumers become a little bit more confident in the second half of this year and get back to spending a little bit, firms like Target, I think, are interesting plays. Target has a very similar setup to what we just introduced initially at the beginning with Merck's. This is a $175 stock, that traded all the way down to, about 85. So basically lost half its value here in the last year or so. But since then, since it's completed this kind of bottoming formation here around 100, it basically traded sideways here for basically 3 months, popped higher here, came back to retest this level of support, and so far continues to make higher highs and higher lows. But what's really interesting here about Target, besides the timing on this, is the fact that Target only trades at 14 times forward earnings. If you look at kind of most of the big box retailers, Walmart, Costco, Target, Kohl's, Kroger's, because a lot of these are kind of still, supermarkets, basically, big box supermarkets, growth expectations for most of these companies are very similar. You're looking at about EPS growth around 8 to 9% per year. You're looking at revenue growth somewhere in the 4 to 5% range. Target is very much in there with regards to those growth expectations, with the exception of revenue growth. The reason Target trades at such a low valuation of 14 times forward earnings versus the industry average is closer to 19 is because Target has really struggled with revenue growth here over the last couple of years. And for those reasons, it's reasonable that it trades at a discount. But Target is a more efficient company than all of the other big box retailers. Net margins are north of 4%. Versus Walmart's like 2.25, Costco's at 2.5. So these companies operate on razor thin margins, and Target is actually exceeds about 75% of its peers from a profitability perspective. On top of that, Target pays a 4.25% dividend yield, so returning a significant amount of cash to investors through that dividend. And I think for those reasons, Target is many times overlooked as an opportunity in the retail space. But if you look at the valuations, you look at kind of how consumer spending habits have shifted here in the last year, and how they potentially are expected to recover in the second half of 2025, that's really where I think Target looks like an interesting investment opportunity given the valuation that's currently trading at. And then lastly, I'll leave you with Micron on the bullish side. So we've also been talking about this for multiple weeks now, probably a couple of months now. Basically, we looked at Micron as it broke out here above this $90 level here. We broke out above $90 after broke out above that $90, came back to retest this level of support, traded all the way up to 130 going into the earnings event. And ever since the earnings event, the stock has pulled back to around this 110 level. And I actually think that this pullback here is an opportunity for anyone who missed out on that initial move to basically look at reestablishing new bullish positions here on Micron. Micron trades at only 9 times forward earnings, which if you look at growth expectations for Micron, it actually, you'd be surprised, it looks very similar to NVIDIA. We're looking at EPS growth expectations that are in the 40 to 50% range. You're looking at revenue growth expectations in the 25 to 30% range, because they supply the high bandwidth memory chips for NVIDIA GPUs. So we've seen a pretty substantial amount of growth out of this particular stock, yet it only trades at 9 times forward earnings, because memory chips tend to be commoditized. There's a fair amount of competition in this particular space, but because Micron has kind of shifted their business here away from doing or producing memory chips for personal computers, and shifted their business towards, automotive chips as well as GPU chips for NVIDIA, it's becoming a less commoditized business and deserves to trade at a higher multiple. Not to mention Micron, has net margins north of 18%, where the industry average is closer to 10. So it's more profitable. It's growing at an incredible rate, yet it only trades at 9 times forward earnings. And that's really where I think Micron is an interesting play, from a hardware perspective within the AI space. Because, if you're interested in hardware, or if you're interested in exposure into the hardware side of AI infrastructure, you have your obvious plays such as NVIDIA, you have Oracle, you have Supermicro, you have IBM, you have Dell, you have those types of companies. But they're all trading at valuations substantially higher than Micron at 9 times forward earnings. So it's a commonly overlooked name within AI, because we don't think of memory chips as kind of, the semiconductor industry, or the sub-industry within semiconductors that has a lot of exposure to AI. But Micron happens to have a fair amount of exposure to AI, and I think is an interesting opportunity from that perspective. And then looking at some bearish opportunities here, just to balance some of these views out. The first one I want to take a look at here is CrowdStrike. Now, CrowdStrike has been in the news a lot lately because, there's been a lot of hacks, and CrowdStrike being one of the leaders of kind of cloud-based, cybersecurity softwares is in the news a lot, which is a good thing for the company. But as you can see, the company has really kind of stalled a little bit after breaking out here above this, call it $450 level here. Broke out here above 450, has kind of now traded back to 450. You could say that this is likely going to bounce off and continue moving higher here. But if you look at the trend quality here over the last couple of weeks, it's deteriorated a little bit. And that's giving me a sense that potentially this could fail at this 450 level and trade back below it. And then when you look at the fundamentals here, this is really where it gives me a lot more conviction of a potential breakdown, rather than just a bounce off that support and continue moving higher. CrowdStrike trades at 133 times forward earnings, which is just sort of ridiculous on all measures. On top of that, CrowdStrike trades at 28 times revenue. I remember back in the kind of the peak of the pandemic, and there was all these speculative names at the time, with lithium battery companies, EV companies, that were trading at ridiculous valuations. Palantir back in the day was trading at pretty ridiculous valuations, and you can argue they're still trading at pretty ridiculous valuations. Even in those days, 20 times revenue was a pretty stretch name. And that was kind of the peak when the pandemic, from a valuation perspective, things were trading at. I was trading at 20 times forward earnings. CrowdStrike is trading at nearly 30 times forward earnings. So just on all measures, this stock looks really, really expensive. So, typically when you see those types of valuations, you would expect to see growth expectations that are incredibly high. And they are decent, but they're not revenue growth around 22%, EPS growth around 18%. Those are high numbers, but not nearly as high as Nvidia, not nearly as high as some of the other AI specific names. And then more importantly, CrowdStrike does not turn a profit. Their net margins are negative. So for every dollar they earn in revenue, they lose about 4 cents in net income. So when you factor all of those things in, the valuation that's trading at is just becoming somewhat untenable. And that's really why, from my perspective, looking at this, the technicals seem to make sense where this is more likely to break to the downside. With that, that covers what I wanted to share with you here today. I hope that this helps you in giving you a better understanding of what our views are from a broader perspective. We are reaching some very stretched valuations and stretched conditions in the market with a VIX below 15%. It does potentially justify looking at buying some downside hedges in the market. They're incredibly cheap right now. You have a lot of things coming up in the economic calendar, in the earnings calendar. So keep your eyes peeled for that. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.